We got the government's version of inflation, or not necessarily inflation, the increase in the consumer price level, which some people consider to be inflation, but which actually is more reflective of inflation. It's not inflation itself. But we got the government's version of the increase in consumer prices earlier this morning. And according to the government, consumer prices during the month of June increased by 0.3%. And that's matching what the consensus forecast had been. That's slightly below the 0.4% that we experienced during the prior month. Year over year, though, from June 2013 through June 2014, consumer prices are up 2.1%. Now, 2.1% is greater than 2%. All right, so we are above the Fed's official ceiling or target or whatever. But more importantly, if you take the last 4 months and you annualize that, we're well above 4% annual inflation. So if the last 4 months are indicative of where we are and not simply the last 12 months, because if something has changed and that the rates that we're experiencing in the last 4 months are likely to be repeated during the remainder of the 12-month period going forward, that would mean that 8 months from now, we would have a year-over-year inflation rate above 4. Now, the question is, can the Fed allow that? Now, my answer would be they have no choice, realistically, given their objectives and the way they think. But the market obviously doesn't believe that the Fed would allow that. In fact, all of the talk about this CPI number is that if it's hotter than people think, might the Fed be more aggressive and might they raise interest rates sooner than people think? But nobody seems to be concerned about the actual problem, which is that inflation will stay high, but that the Fed will do nothing. That is the real problem, that the Fed will, ignore the inflation while it gets worse and worse and worse. Because the fact of the matter is they can't raise interest rates without collapsing the economy. And the people who are assuming that the Fed might react to inflation by raising rates are underestimating the impact that higher rates, even a slight impact in rates, would have on the fragile bubble economy that the Fed has worked so diligently to inflate. Now, of course, there's a lot of stupid things that are said by, otherwise intelligent people on financial television, particularly CNBC. And of course, the stupidest stuff that gets said on CNBC has to do with inflation. And today is certainly no exception to that. They were talking quite a bit about inflation, both before and after the release of the official CPI numbers. And I want to play a little sound from this discussion from earlier this morning. This is with Arthur Brooks, who is president of the conservative think tank AIE, which proves, again, economic ignorance is not something where the liberals can claim a monopoly. There is plenty of ignorance in the conservative camp as well when it comes to basic economics. So here is Arthur Brooks discussing economics with Steve Liesman, the senior economic reporter from CNBC. If you took what both of these guys knew about economics and you can harness it and turn it into electricity or something, you couldn't even power, one little light bulb. But anyway, it was a very, very entertaining discussion from my perspective, which is why I recorded it. But have a listen to this discussion about the absence of inflation in the United States. Here, cut number 6.
The truth is that most people who are in their 20s and 30s and 40s have never really experienced any sort of inflation. So there's no cultural bias necessarily against it. On the contrary, anybody who's paying attention knows that when you have a deflationary threat, it's even worse for the economy because it's so horrible for labor markets. So you have anything approaching deflation, you get more layoffs. And that's the kind of environment that we've tended to be in. Now, the truth is that the fundamentals suggest based on everything that we've learned over the past 75 years, that sooner or later we're going to pay the piper. But you don't know how much run room is left. Right.
So let me get this straight. According to this guy, nobody in their 20s, 30s, or 40s has experienced any sort of inflation. Now, I guess that leaves me out because I'm in my 50s, so theoretically I've experienced some inflation. But I guess I only experienced it in the first 10 years of my life, right? I haven't experienced it, since I was 11 or 12. So, I'm thinking, well, are prices still the same as they were when I was 11 or 12? Is he really saying that prices have not gone up in the last 40 years? We have not experienced inflation? Is he crazy? I mean, I remember, again, when I was going to the movies, when I was, 11, 12 years old, the child's price was $2 to go to the movies. Now it's 11. At least that's what I just paid to take my son. I think the adult price was $3.50, $4. I used to go to high school in New York. I used to get $2 a day for my lunch money. I used to eat in restaurants, and I always got change. I never spent the entire $2. Lunch would cost $1.60, $1.75. What can you get in the city for $1.60? You can't eat lunch. I mean, to say that there's been no inflation in the last 40 years, I mean, what is this guy, nuts? Of course we've experienced inflation. In fact, we're experiencing right now. Doesn't he look at the polls? America's biggest concern right now is the increasing cost of living. But what does he say to make it even worse? He says that our real threat is deflation. That's what we're living with. We're living with deflation. No, we're not. There hasn't been a single year since I've been alive where prices ended the year lower than they began the year. There is not one example. We have not dealt with falling prices. Not that that would be a bad thing. That would be a benefit. But to say that the real problem for Americans in their 20s, 30s, and 40s is deflation? What is this guy kidding me? It's not even close. Now, he does mention briefly, hey, eventually we have to pay the piper, but you don't know how much room is left. Look, the piper is getting mad. The piper is already past due and getting ready to present us with a bill that we have no chance of being able to pay. But to try to claim that we've had no inflation whatsoever, right, for the past 20, 30, 40 years is an absurd contention. And Steve Liesman, he doesn't contradict them. They all agree. None of us have experienced inflation. We don't even have any idea what it feels like. Well, you know what? If what we've been experiencing these past 10, 20, 30 years is zero inflation, can you imagine how bad it's going to be when we actually have what the experts would consider to be inflation? You know how bad that's going to be? I mean, it's going to be off the charts compared to, what we had during the 1970s, which apparently, according to these experts, is the only decade where we actually had inflation in this country was in the 70s. But there's actually, believe it or not, some of these statements get progressively more absurd as they continue. I remember when I first started driving when I was 17, what I was paying, 69, 79 cents a gallon for gas. I remember when gasoline went above $1 for the first time. Now I'm paying, $4 and change. I mean, isn't that inflation? If it's not, that certainly is something that's been experienced, and certainly if you're 40 years old, you've experienced that too. I remember when my parents bought gas. Clearly, it was at 25 cents a gallon. I mean, plus it was full service, and they would get green stamps, and I'd get a toy. All kinds of stuff happened back early in my life. But let me continue with these cuts. Here is where Arthur Brooks brings up the velocity. We talked about that the other day on the show, saying that, velocity is down, so we can just print all the money we want, right? Here, cut number 7.
What actually is going to happen? Well, look, two things really have to happen. Number one, velocity has to. Velocity is.
Let's talk about what velocity people understand. Okay. It's I give $1 to Andrew. He's going to give it to Michelle. Michelle's going to pocket half of it. Give some of it to Joe, and Joe's going to give it to you. You're going to pocket a few. Whatever happens, that's velocity, and there's not a lot of it right now.
It's very low. It's almost historically low. And so when velocity is extremely low, what happens is you can print money all day long, and it doesn't pass around the economy. It doesn't spark inflation. It doesn't drive the price level up.
Yeah, it does. But if velocity really picks up, then yes, it can have an accelerating effect on prices. And the situation is, even if velocity is historically low, what does that mean? That means at some point it's going to mean revert, which means the velocity is going to pick up so that it reverts to the mean. And the Fed doesn't have any control of that. And if inflation has been temporarily held at bay, if the effects of it, if the effects of the money printing have been held at bay because velocity has been below trend, when velocity mean reverts and goes above trend, right? Then what happens? What is the Fed going to do? He's admitting that, well, yes, maybe inflation is subdued temporarily until velocity picks up. Then we're screwed, right? That's basically what he's saying. But again, he doesn't care about what happens in the long run. But here is probably an even worse comment. Again, from a relatively smart guy that still doesn't understand anything really about this particular topic, inflation. Here, cut number 8.
The other thing is when you print money, when you're the reserve currency of the world, because everybody else's currency sucks worse, which is effectively what we're talking about in the worldwide macroeconomy today. No matter how irresponsible you are, you can keep printing money, and foreigners will keep
it's a free loan.
And exactly. Well, it's basically like finding gold in your hills.
Right.
You can print money. Seigniorage is what we call it in economics. Okay, so it doesn't come back. Things sooner or later have to change.
Yeah, sooner or later. See, that's the problem. And it's actually sooner now, not later. But what he's saying is that we can export our inflation abroad, which is what I've been saying we've been doing. And it's not that everybody else's currency sucks worse than ours. Ours actually sucks the most, except that our trading partners don't understand that yet. But he's correct in one respect. Since the dollar is the reserve currency, we can print a lot of dollars that are sent abroad and they don't come home to bid up prices. And so we've exported our inflation to our trading partners. But the idea that we can do that forever is absurd. And the point, and my fear is that we're already approaching the time where we can't do it anymore. And not only can't we do it, but that's when foreigners decide they want to give us our inflation back. See, we haven't exported the inflation permanently. We've only done it temporarily until the foreigners that are warehousing our dollars decide they don't want them anymore and they want to spend them on stuff. And that's when they come crashing back. So we've exported the inflation. Eventually, it's going to come back, like a tsunami. Right? It's going to crash on American shores. And then what do? He said, well, we can print all this money now because it's not causing inflation now because we've exported the dollars. But when our trading partners realize that this is our plan, that we can be as reckless, as irresponsibly as we want, and we're going to do it forever. Because, again, that's another thing that this guy's got right. He says that it is irresponsible. What we're doing is irresponsible. But he said we can be reckless and irresponsible because foreigners have got us covered. They've got our backs. They are going to absorb all the excess money we create. Well, they're not that dumb. Right? You can't fool all the foreigners all the time. Eventually, they're going to stop. They're not going to want to play this game anymore. Here is another cut from this conversation where they start talking about bubbles, which is another byproduct of inflation. Here, cut number 9.
It's been debated for many decades the extent to which asset prices should be folded into the measures of aggregate price levels. And it's been decided by a lot of guys who have thought about it a lot that, for example, housing prices don't belong.
And how do we have any idea what stock prices are worth? How would you even do that?
And more so, Joe, I'd push back on you, which I've been talking to a bunch of guys about, which is, okay, let's say we accept the notion that the Fed is boosting the stock market. What's the mechanism? If Arthur's concept is right that there's no velocity,
just moving out the risk curve, you can't get any because you don't get any return anywhere else.
Okay, so it's a decision. Okay, so but is there a lot of extra leverage in the system? Is margining extra high right now?
Well, the answer to that question is yes. Margin debt is at a record high. And what is the mechanism? Steve Liesman is wondering what the mechanism is that low interest rates translate into higher share prices. How about stock buybacks, where companies borrow money cheaply and use the cash to buy back their stocks? What about the fact that older people who can't get returns on bonds are having to buy stocks because it's the only way they can hope to achieve the types of returns to maintain their retirement? What about pension funds that are being forced into the stock market because they can't get yield anyplace else. And what about the fact that rising stock prices that result from cheap money feed upon themselves? Because rising prices encourage a speculative can't lose mentality. I mean, is he really serious about saying what is the mechanism by which low interest rates fuel a bubble? Did he not remember the bubble that just burst in 2008 in the stock market and the housing market? Did he not remember the bubble of the tech boom of the 1990s? I mean, they reported on this stuff. Is he serious? What is the mechanism? And then in here he says that, well, all these experts agree that we shouldn't consider rising stock prices or rising real estate prices inflation, or we shouldn't worry about it. What experts agree with that nonsense? I mean, that was the mentality that led to the financial crisis of 2008. It was obvious that the Fed was too loose, that asset prices were rising because of inflation, and the Fed should have taken away the punch bowl, but it didn't do it because they didn't want to worry about or consider rising asset prices as being somehow indicative of too much inflation, of easy money. But of course, that was exactly the problem. And it's the same problem now, and this same fool, Steve Liesman, who was blind to it then, is just as blind to it now. And I don't even know what his excuse was then, but he certainly doesn't have an excuse now. We're talking about the coverage of inflation. We got the government's version of the increase in the cost of living earlier today. 2.1% is the year-over-year increase in consumer prices, the official year-over-year increase. Of course, unofficially, we're all paying a lot more than 2.1% for the things that we buy than we did a year earlier. But the government claims it's just 2.1%, and most people on Wall Street just accept that as if it were actually true. But still, 2.1% is above the 2% target. And if you take the most 4 recent months and assume that that's the new trend, inflation is now averaging at over 4% annualized. And that obviously is far above the Fed's expressed comfort zone. But the Fed is going to get comfortable with that as far as I'm concerned. They will tolerate increased inflation no matter how high it gets, because to do anything about it would collapse the bubble economy. That is something they do not want to do. So they would rather have inflation than recession. They just don't want to publicly admit that, because that will make the problem even worse. So they're going to deny the inflation. They're going to rationalize it. They're going to justify it. They will even say that it's a positive. But the only thing they will not do is try to put a stop to it by actually doing something. They'll try to talk the inflation rate down by talking about the fact that, yes, well, if it ever really becomes a problem, we'll do something. But since it's not really a problem right now, we're not going to do anything. But don't worry, if it ever becomes a problem, we will be Johnny on the spot, which, of course, they will never do. But they're counting on people not to believe that. Now, one of the other problems, of course, with blowing bubbles or printing too much money, in addition to the price of food going up and the price of electricity going up, the price of stocks goes up, the price of real estates go up, and that distorts decision-making, resource allocation. It leads to dangerous imbalances in an economy that build up over time and then burst in a spectacular fashion, such as what happened in 1999, more spectacularly in 2008, and even more spectacularly in either, 2014, 2015, 2016, whatever the current bubble bursts, it's going to be an even bigger disaster than the previous two, because the bubble this time is even bigger. But of course, just like nobody saw the previous bubbles, the same people are oblivious to this one. Case in point, Steve Liesman today on CNBC. Here he is, cut number 10.
Things can be overvalued or highly valued and not be a bubble. A bubble is a specific thing. When it busts, it's messy.
But we never knew about it until look, even Bernanke,
I can't argue with that.
The greatest economist in history,
some
time, people say, didn't have any idea in 2007.
That's what was happening.
That's how bubbles work?
That's true.
That's how bubbles work.
Okay, so basically, they agree, Steve Liesman agrees with Joe Kernan, that you can never tell you're in a bubble until after it bursts. Because, right, he says, well, you can be overvalued and not be in a bubble. But that's what they always say during a bubble. Nobody that's participating in the bubble right, believes it's a bubble, because if they did, they wouldn't be participating in it. So they always rationalize it. That's where the famous words, "this time it's different." That's what they said in the 1990s. That's what they said in the 2000s. This time it's different. This time it's not a bubble because of this, because of this, because of this. The valuations are justified. They may be stretched. They may be a little high, but hey, that's okay, because things are so great that the valuations can be a little high, because, that's how good it is, and it's different this time. It's not like that last time where it actually was a bubble. This time it's not. Well, it's never different. This is exactly the way it was last time, only it's bigger, right? And he even admits that. He goes, well, yes, I guess we never know a bubble, because he admits all the great minds, all the great economic minds in the world didn't see the last bubble. And that's because they're not such great minds. There are plenty of minds like mine, and I'm not saying it's so great, but there are plenty of minds that saw the last bubble, and they're the same minds that see this bubble. It's the minds that were oblivious to the last one that are similarly oblivious to this one. But in this discussion, they basically say, well, I guess you're right. We only know there's a bubble in hindsight. Well, if that's the case, how can you argue that this is not a bubble? What you should say is, I have no idea whether or not it's a bubble. We'll have to wait and see. If it pops, it's a bubble. If it doesn't pop, it's not. Well, what kind of ridiculous logic is that? Like, do we really need a senior economic advisor with that kind of insight to say, well, I guess if the whole thing blows up, then it was a bubble? Well, if you have to wait till the bubble bursts before you recognize it, what good is that? All the damage is already done by the time you can spot it. The truth of the matter is, it already is a bubble. You don't have to wait for the benefit of hindsight to know. If it walks like a bubble and talks like a bubble and quacks like a bubble, whatever, it's a bubble, right? But they don't want to admit it, because they don't want to acknowledge reality. And the Federal Reserve never wants to. Why do you think they didn't want to prick the housing bubble? Because they couldn't. Because the whole economic recovery was based on that bubble getting bigger. That's the case right now. The Fed is betting everything on the wealth effect of houses and stocks. Therefore, how can it acknowledge that wealth is based on a bubble? Because then it's phony. So they have to ignore it. They have to pretend it's not a bubble, because otherwise their whole narrative, their whole economic policy blows up. So instead, it blows up in the future because they deny the reality. But when it does blow up, it's that much bigger. Now, the interesting thing is going to be, what are these experts going to say the next time? When it all hits the fan and it all implodes, or if it doesn't implode and we have runaway inflation, what are they going to say then? Right? Is it going to be the same old, right? Here's the final cut I've got on this topic, number 11.
It's not just American capacity, right? Capacity in China, in Thailand, and in Vietnam plays a role in the price level here in the United States.
For sure.
So it's not just here. And honestly, we haven't really been through this before. It's labor capacity over there. It's factory capacity over there. I think that what's happening in China right now is going to have a huge impact on inflation. I don't think we are on the precipice of runaway inflation. I do believe in the overall concept, which has been part of monetary policy for many decades. The Fed can pick an inflation rate. It can get to where it wants to be on inflation, and it should be able to get there. It's going to have its foot down on the pedal for quite a while. So I think a slow exit is probably the best course here.
Okay.
Thanks, Steve.
The Fed can just pick whatever inflation rate it wants and just magically make it happen. Not a chance. What complete ignorance expressed by Steve Liesman in that comment, that the Fed can just pick whatever it wants. And then to say that we can rely on all the excess capacity in China, you see, what he thinks about is, well, if the Fed prints more money, and as long as there's excess capacity, then we don't have to worry about inflation, because businesses will just produce more stuff, and so there's more stuff to buy. They only think that if you're at full capacity, if the Fed prints money, then businesses raise their prices because they can't produce more because they're at full capacity. And he's saying that we can rely on the Chinese capacity, as if the Chinese are going to be dumb enough to keep producing more stuff and sending it to us, no matter how much irredeemable paper money we want to print and send over there, and expect them to hold it in irredeemable or worthless U.S. treasuries. It's not going to happen. Foreigners are going to say no mas to this money printing. They're not going to keep accepting our paper for their stuff forever. We cannot claim China's capacity forever. That's Chinese capacity, and they're going to reclaim it for themselves. America be damned.